$60 price target. What are you seeing that everybody else is not seeing?
I look at Carvana, and their management team has done a great job getting out of the debt situation they were in. They still have a mountain of debt, but they bought themselves quite a bit of time. I think they're also one of the only management teams we've seen kind of benefit from the pandemic, grow at all costs, and then turn it around and start to drive profitability. So the management team's done a great job executing. As I sit here today and I look forward with car prices coming down, interest rates coming down, affordability should start to improve. And I don't think the street appreciates how quickly Carvana can ratchet up volume with their direct-to-consumer model, and they have a high fixed cost model. So as volume comes, profitability should come, which over time should help them solve some of the debt situation they're still in that they will need to address in the future.
All right, Nicholas, really quick though, $60 price target implies about 20% rise from here after the huge rise we've seen already. What's going to be the catalyst for that extra 20%?
I think it's top line growth. Right now, the street's looking for kind of low to mid single digit growth in 2024. Some third party data sources we've heard are already showing closer to 10% quarter to date. So if they see top line growth, I think that can get the stock moving. And I'd also like to point out short interest in the stock is 35% right now. So as the stock starts going, it kind of becomes a self-fulfilling prophecy that could drive the stock higher.
All right. So, Brad, I want to come over to you. You actually are appreciating the fact that Carvana might sell more units than the estimate is, but still you have a sell on this stock. What is the downside of this stock? What do you think is going to be the metaphorical speed bumps on this car retailer?
Yeah, totally. So, and our price target is $24 for what it's worth. We had taken it to a sell at about $56 last July, I think. So, I think the real catalyst here, and to Nick's point, I think, it does appear units for Q1, based on third-party data anyways, are tracking ahead of sell-side consensus. But, I think we kind of step back, bigger picture, and say, look, this company is generating maybe $400, $500, $600 million over the next couple of years in EBITDA, and they owe a little bit over $9 billion in the next 6.5 years. And again, to Nick's point earlier, I think the goal here is to grow and to show that you can produce profit, and then probably refi some of that debt, and then sort of, buy yourself even more runway. Totally fair. I think we think that as units start to ramp back up to growth, we think there's going to be ad spend. We think there's going to be other operational costs to ramp those up that may de-lever the model and drive investors to say, you know what, we're not so sure about this working out.
Yeah, Nicholas is really focused on the fixed costs being a positive, but you're saying there's variable costs like marketing and other things that might create inefficiencies. How deep of an impact do you think that could be going forward? Obviously, Carvana is a pretty well-known brand.
Yeah, absolutely. I think when you go back to even, the company went public, I believe, in 2017. And throughout that time up until COVID, they pretty much missed operating expenses almost every quarter. They would beat on retail units, they would beat on gross profit per unit, but then generally would often miss on operating expenses. It's a very, very labor-intensive, metal-intensive, physical-intensive business to ramp that business up. And they do have some aspects of underutilization on their capacity, but I would tell you it's a very, very small amount. We think probably less than 20% of the total cost base. We do think there's a lot of inefficiencies that could occur as the business starts to grow up versus running it kind of in a test tube where they've been running it lately to produce this outsized margin expansion.
Yeah, obviously following a massive restructuring. Nicholas, I want to come back to you. You're very bullish on the stock, but you admit there's a very challenging wholesale environment. How does Carvana overcome this challenging environment?
They've done a great job self-sourcing cars. And again, I'd point back to kind of the strong brand that you alluded to earlier. They've been able to source cars well, which means they're able to kind of remove some of that wholesale pricing. So to the extent that they lean into that as a lever, that could be a workaround. They are still very small relative to the size of the used car industry. So while they are a large player relative to, a CarMax and some of the other players, the top 10 used car dealers represent less than 10% market share of the entire ecosystem. So I think there's plenty of room for them to take share from the long tail of dealers out there, whether it's in the wholesale environment, sourcing cars, and in the retail space.